Have you been told you can't get a HELOC because of your credit score? Or maybe someone said you need perfect credit just to qualify? Here's the thing. That's not always the full story. Your credit score matters, but it's not the only thing lenders look at. Hey, my name is May, Fannie Mae West digital twin. Fannie is a mortgage and wealth strategist who teaches how to use debt wisely to grow wealth. So today, let's talk about what lenders actually look at. Because approval is less about a single number and more about how the whole picture comes together. Does that make sense? Your credit score is a snapshot. It shows how you've managed credit in the past, but it doesn't tell lenders everything about your financial situation. So what else do lenders look at? Income stability, not just how much you make, but how consistent it is. Your debt to income ratio. That's just how much of your monthly income is already spoken for by other debts. Your equity position. How much of your home do you actually own? And your payment history. Are there recent issues or are the problems older? Because here's what most people don't realize. Timing matters. Patterns matter more than perfection. Now, here's something else that's important to understand. Not all HELOC programs have the same requirements. Some programs are more flexible than others, and some look more closely at what we call compensating factors. Things like how much equity you have, how stable your income is, what you're using the money for. With lower credit score, your terms are not going to be the same as someone with a 750 score. The rate might be higher. The approval process might require more documentation. But here's the question I want you to ask yourself. If you're sitting on $100,000 in home equity and you're paying 24% on credit cards, or you need capital to handle something that's costing you money every month, is a HELOC at 10 or 11% the problem? Or is staying stuck the problem? So let's talk about what actually matters in the approval process, because this is where strategy comes in. One big factor is cash flow. What's coming in versus what's going out every month. Someone can have a decent credit score and still be stretched too thin. And someone else can have a lower score, but strong income, manageable debt, and room to breathe. That difference matters to lenders. Another thing lenders look at is how your debts are structured. Sometimes the issue isn't your credit score at all. It's how your payments are set up. And that's something we can often adjust with a plan. So when I sit down with homeowners, my first question usually isn't what's your credit score? It's what are you trying to accomplish? Because once we understand the goal, we can look at the full picture and decide what actually needs attention. Let me give you a real world example. Let's say you have a 620 credit score. You've got $120,000 in equity in your home. You're paying $850 a month across 3 credit cards. And those cards are charging you 22 to 24% interest. Now, could you get approved for a HELOC? Possibly. Depends on your income and your debt to income ratio. But let's say you do. And the rate is 10.5%. You use $30,000 from that HELOC to pay off those credit cards. Now, instead of $850 a month at 24% interest, you're paying maybe $400 a month at 10.5%. That's $450 a month back in your pocket. In 6 months from now, your credit score is higher because your credit card utilization dropped. That's not just debt payoff, that's strategy. And that's what we mean when we say mortgage is the vehicle, wealth is the destination. So here's what I want you to take away from this. Your credit score is information. It is not a verdict. It tells part of your story, not the whole thing. And if you've been holding back because someone told you your credit isn't good enough, it might be worth a strategy session with Fannie Mae West at book.fanniemaewest.com. And if this was helpful, subscribe for more HELOC strategy and watch the full HELOC Mastery playlist.